briefly, Lee, I wanted to talk about what I've been noticing in the banking world as regards to cryptocurrency. Beginning of this year and last year, banks were at a mad dash to integrate the purchase of cryptocurrency through their online banking platforms. And there was a number of companies that were setting up and being an intermediary to that. I was seeing banks that the rewards on their debit cards were going to they could redeem them in Bitcoin and that area. But, with the downgrading in the price of Bitcoin earlier this year, you started seeing regulatory notices. Back April, FDIC was sending out notice that, hey, any bank that has anything to do with crypto-related activities, you got to notify us right now. So they want to know if there's any banks that had any risk in owning cryptocurrency, if any of their customers, if they were ownership of platforms that were selling cryptocurrency. So, that just kind of tells you right there. Normally they don't send out, notices and say, hey, are you dealing with this product?
Sure.
So that was a little preemptive. And then from there, and then in August, the Federal Reserve, sent more supervisory insights saying, hey, here are the steps that you need to take, and you want to start engaging in this activity. A lot of it is very, very bland. They don't give you specific steps, but it follows all the other risk-based practices you do with all new products and services, and but they want you to really, yes, and they want you to really take your time, understand it, know who you're dealing with. Know your risks, and with this administration, they're also concerned, and everybody should be concerned as how does it impact consumers. Are they being told the volatility of the market and everything that fact? Right. But even so, companies that had raised a ton of money, CoinDesk had mentioned in an article back in middle of October that NYDIG, who was one of the preeminent ones that were they go between banks and their online to be able to purchase Bitcoin. They had raised a ton of money the prior year. And then in October, CoinDesk had reported that they laid off a third of their workforce, over 100 employees over the previous couple of weeks. And so they even have an employee quoted in the article saying that they put all their eggs in the banking strategy, but they realized there was no way that these banks were ready. And the employee even went on to say they blew through all this money telling a story that they would bring Bitcoin to the masses. Their core strategy was blundered.
Yeah.
So it looks like, there's going to be a stall, at what time will banks, online banking truly be able to purchase Ethereum, Bitcoin? There may be a few out there, but it looks like that mass adoption for that is going to stall. But on the other hand, too, true, zealots, are they comfortable with wanting to buy through their online banking anyways? Mm-hmm. It's very easy to have another app, click on another app on your phone and to, purchase Bitcoin in other ways, whether it be through Cash App and Robinhood and everywhere else. So,
right.
I don't know.
I mean, from the compliance side, it always takes longer than I think the businesses want it to take, but it makes sense, right? You can't trip over your own shoelaces trying to get to a goal where that goal may not be even appropriate. And from the consumer side, I think about it like technology historically, you've got everything from vinyl records to CDs to 8-tracks to tapes. Like, you want to push the technology's there and ready to go, and the consumers to some extent may be hot for it, but you can only push so fast, right?
Yeah, but also the regulators have banks do need to know their products, but banks, they do. They are highly regulated. They've been regulated for years. So kind of what happens is this is really a scare tactic because they're not ready for it. They don't know what you're doing.
Right.
And so with banks having more adoption, there does also come better protection out there. Now, then you have companies that actually have long-standing capital that, aren't just burning through revenue at a unicorn. We can't do that. Mm-hmm. So, it is better to have banks involved in transactions. We have a lot better strength, a lot more strength, a lot more stability. So,
Yeah, I agree. I just think that adoption curve is going to be a lot longer than some people want it to be.
Yeah. I mean, you can't run into things if you don't know what you're doing. But
That's right.
yeah, also, it's got to be regulated, but the overregulation, it's way too much. It scares all the good actors out of business.
Yeah. So then what's the solution? You know, I mean, if you were on the regulatory side, how would you make it better and bring banks into it cleaner?
You know, still have that conversation with them, but don't scare the crap out of them that, hey, you get into this, we're going to come down on you.
Yeah.
You know, yes, they need to follow the same course for every product and service. Look at the disclosures, you know, what they're telling their customers, what is their risk, and who they partner with, you know. So
and does that happen mainly because the regulators don't know what they don't know? So they're trying to mitigate disasters that they don't even know what the disasters really could be or the extent of what they could be. So the regulators are trying to.
It's the fear of the unknown.
Yeah, they don't.
It's the fear of the unknown, and you know,
they work on policy.
You know,
so
they work on policy, and you've got the FDIC. They're insuring depositors' funds, so anything that potentially could put that fund at risk, yes, they need to oversee and do that.
Of course.
So it is the unknown, and then it's overregulation, and you know, they don't know what they're auditing.
Yeah.
You know, they haven't had time to train staff. They haven't gone through this. So it's, you know.
Yeah. Yeah. It makes me think of, you know, Bitcoin and a lot of the cryptocurrencies, respective to what they are. It's kind of an and conversation, not an or. Like, this is not going to be, in my view, from a consumer view, it's not going to be the end all. I think there will always be multiple forms of payment, multiple forms of currencies. You know, I don't think it's going to ever be like with the internet. You know, the internet comes along and there's a group of people that are early adopters that think this is everything. It's going to take over everything. It's going to be everything. And there's still a lot of offline stuff that happens in our world.
But they also lump in all bad actors in with the good ones. So, you know, where stable coins weren't stable. No, they were not stable. They weren't backed dollar for dollar. They were investing that. So, I mean, yeah, they weren't stable at all. Yeah. So then they're going to lump that in with the fact that, hey, just the consumer wants to buy cryptocurrency and make an offering, the availability that they can purchase through it. Those are two different things. Yeah. This is not coming up with another coin, calling it stable when in fact is not. And, you know, those companies not sharing their truly audited financials or showing their back. So
you're talking about the algorithmic.
Yeah. So, you know, they lump it all into the same category as opposed to just offering the ability for somebody in their online banking that they were going to do anyways.
You think that's because they don't understand it fully? I mean, that's kind of what I'm getting at, is that they just don't know what they don't know.
100%. So that has a lot to do with it.
They try to regulate something they don't even really understand.
I mean,
and where, from your vantage point, where are they at in their education curve, like the regulators? Do you think that they're pursuing this?
Oh, it's complete catch up.
It's all catch up. But are they like pursuing it and trying to really get ahead of that curve and understand what it is that they're dealing with? Or are they just sort of always reactive?
Reactive. I don't see it on the banking side.
Yeah.
In regards to cryptocurrency. It's still, you know, for the most part, the head of the organizations, they don't purchase it. They don't see the need for it. So why would anybody be doing it? So you've got that mindset going into it right off the bat.
Yeah.
You know, but I mean, you don't have to be a zealot. You know, you don't have to believe that you should own it, but the matter of fact is there's a huge number of people that are purchasing it.
I would think the pressure from all the fintechs that have come online, you know, as it pushes pressure into the bank.
Well, here's the thing. The fintechs aren't capitalized like banks are. So to me, it would be a lot better to have better framework and not scare the shit out of banks not to get involved.
Yeah.
So, you know, that's what they do in more products. And then it pushes it out in the fintech world. And to me, that is a bigger disservice to consumers.
Yeah.
So now you got fintechs that, you know, they've got a unicorn valuation. They burn through their money and they're gone. They don't have any setup. And then who's left handling the calls and who's helping the consumers get their money out of their wallet? They don't know who the custodian is and everything else because there's nobody left. And ultimately, too, that's what banks really need to be concerned with, of tying into the fintechs and seeing that they actually have a profitable business, that it is just not, oh, we're going to get profitable later by getting users, because at the end of the day, if that bank is sponsoring that fintech, they're left holding the bag.
Yeah. So then what would be, if you're sitting in a room full of bank CEOs or bankers, then what would you tell them how should they be thinking about this problem, both from adoption and regulation?
I mean, same as any product, walk through the steps. What is the risk, immediately to the operations? How do you move that in? Are you using your existing staff? Are you having to add new staff? Who understands it? Who's following just go through the same thing of any product and service that you're adding it on. It's not rocket science. Go through the steps.
Yeah.
Go through the committees, prepare a risk assessment. First of any banking product is prepare a risk assessment.
Yeah.
Walk through the steps, go through it. Look at the companies that you are going to align with and make sure that they have funding, that they have the backing, that they have the know-how. And
so diligence.
Correct. And two, if a bank is going to possibly sponsor, and when I say sponsor, that is almost like, them utilizing your charter.
Mm-hmm.
So you're sponsoring them. They're almost acting as an agent on your behalf, whether it's for issuing debit cards, transactions. At the end of the day, if they don't make it and you're sponsoring, you better be able to take over that plan immediately. And if you don't have the staff to be able to jump in their shoes, then you have no business sponsoring that entity. And so, really, I think that's the biggest risk out there for banks, that they sign it on for sponsorships thinking that, hey, we're going to sponsor, we're going to get a portion of the revenue, and they're doing all the work.
Yeah.
Okay, well, great. You may have a lot of deposits on your balance sheet that they marketed to. They're handling the cards. They're doing everything in their fintech, okay, great. They got 50,000 customers that you don't have to have the staff to handle the calls, or if they're issuing cards, the chargebacks, and the online issues or anything. Oh, well, the fintech is handling that. That's what they're good at. Well, what happens if that fintech goes out? They can't get funding, that they weren't making money? Because I've never seen financials of a fintech that is making money off of interchange and it's truly profitable. They're going to have to sell data, or they're going to have to sell to a larger bank that is going to utilize those customers to sell them other products and services.
Right.
So, if that fintech goes under and you have 50,000 customers and their money is then aggregated on that bank's core, who do you think they're going to call? So if the bank doesn't have immediate access to that fintech's records to see, that yes, Lee does have exactly, $2,403 and has access to that money and go out, what are you going to do? You better be able to jump in that position.
It sounds to me, as an outsider, a lot like how you would assess risk on commercial loans, because you have to sort of, to a large extent, understand the business that they're in, the risk that you're assuming, the risk that they're assuming how they're using the loan, and a portion of those loans go bad because they've gone out of business, and you have to step in and
you got to
take the
know that
building
property.
back.
What's the time frame to foreclose? How are you going to do that? If it is a hotel, and you got to foreclose, does that mean during that time there's no operation at the hotel? Because you and I both know a hotel's value is worth a lot more when it's operating.
Right.
So what do you do?
Yeah.
If you've got to take over that sponsorship fintech and the resources, you're going to be paying your staff. Clearly it wasn't making money. So you're going to be burning through revenue and paying staff overtime to handle all this. So, before you get in any line of lending, what are you going to do if they're not going to pay? How quickly, can you foreclose on the hotel, sell it, keep it in operation so it's a going concern?
Yeah. So to your point of follow the steps or just walk through the steps, I think that's good advice, because if they look at how they're currently doing business on other lines and they approach it the same way, then the regulation is going to sort of fall in line as to what they owe on that side.
So the guidance and framework that regulators have out is, prepare risk assessment, go through this. That's all great. What I hate is, after the fact, come in and you examine something to see what went wrong, the Monday morning quarterbacks. Oh, you should have caught this. Well, the only reason you caught this is because it did happen after the fact. So that's where I have a big problem with when they come in and play Monday morning quarterback like they were fortune tellers and could have seen it in the beginning when no, they couldn't have. But, I do think it's easy to tell interviewing bank staff, looking at previous practices to see if they were going into it, eyes open. And,
proper measures of documenting things and foresight.
Because you're not going to know everything going into a new line, but
seeking to learn and to know what those things, what's behind the corner, like what's around the corner, it's going to be evident.
Yeah. I mean, it's kind of like knowing that, okay, here's our expectations, but having a fallback if those expectations didn't hit,
right.
And just like in the lending and you've got a portfolio of loans, you don't want all your loans in one type of product. If recession hits, a recession typically affects different lines differently.
That's right.
So you need to be able to, diversify. Same thing, the banks need to do. If they're going to be involved in sponsorship of fintechs, maybe they shouldn't all be in one avenue of, prepaid cards. Maybe they shouldn't be in one avenue of cryptocurrency or,
Yeah.
Thanks for listening to the Paper Podcast. I'm going to do more of these short, abbreviated shows, things that I see out there in the banking world. Please leave your comments, hit your like buttons, follow me on LinkedIn, and look for my blog on ryanggjames.com. Thanks for listening.